The concept of trading gold can be quite confusing for those new to trading, but in this video I aim to make it simple for you. Hi, I'm Lauren Jones from tradingtutors.com. For investors looking for a safe haven for some of their cash, they might like to look to invest in gold. They do this by contacting a gold bullion dealer who will sell them actual bars of gold. Now, some dealers will arrange storage of the bullion for you, or other investors take the bar of gold and store them under the bed, or more likely in a bank vault. For a trader, however, there are several more short-term ways to trade in the gold market. These include trading ETFs, or exchange-traded funds, trading gold futures, and more recently we have also been able to trade gold CFDs. I'm going to concentrate on gold futures, as the futures price is closely based on the actual price of gold. Gold is traded in many exchanges around the world now, but the gold futures market is primarily traded through the New York Mercantile Exchange in the US, which is these days owned by the CME Group. As with any futures contract, there are basic contract specifications which you need to know. Firstly, you need to understand which contract you are trading in. There are 6 gold contracts per year, and they expire in February, April, June, August, October, and December. Whilst trading ceases 3 business days before the end of the contract month, as a rule of thumb, we don't trade in the current contract month. This is to avoid issues with taking delivery. So the December contract can be traded until the end of November, but in December you would be looking at the February contract. Secondly, you need to be able to convert the tick value to US dollars. Gold moves with a tick size of 0.1, which is worth US $10. Or in other words, 1 point is worth 100 US dollars. Let's have a look at a sample trade to understand this. I'm going to look at some charts from Profit Source. We can see here on the last day of trading that gold was trading at about 1721.5 points. As 1 point equals 100 US dollars, this equates to 172,150 US dollars. Say we want to enter a long trade at 1726 points, and we put a stop loss back at 1681 points. This equates to a risk of 45 points, or 4,500 US dollars. If we then exit the trade at 1804 points, we have made a profit of 78 points, or 7,800 US dollars. A third thing you need to know when trading gold futures is the margin. Margin is a bit like a holding deposit and is sometimes called a performance bond. Your broker will take the margin from your account whilst you have a trade in place and return it on completion of the trade, plus any profits or minus any losses. To find out the margin, you can look it up on the CME website, or you can ask your broker. This basic introduction is aimed at helping you get started with trading gold futures. If you are looking to trade a highly leveraged instrument and profit from some short to medium term trades in a strongly trending market, then gold futures might just be for you.